First of all, we'll talk about Transamerica per se, but make no mistake, every IUL, I don't give up which company it is, they all suck. They are never, ever, ever favorable to the client. Now, my introduction should have been, I have a love-hate relationship with IULs. The love comes from me being in the business because of it. Okay. I was a client of this company for 12 years. I had life insurance, I had investments, which, you know, to Samir's credit, who I didn't know, it was introduced to me by my godmother's son, taught me the right way. And I must admit, I didn't really remember a lot of it. But when somebody in my family got sick, it started making me pay attention to everything that I had. Okay. And I'm proud to say, and I'm kind of sad to say that I had a younger brother-in-law that actually passed away. And he had one of these IUL policies. And he was paying like $200 some a month, and his death benefit was only $150,000. Okay, and thank God I replaced that with the life insurance policy with us, where he was paying only $100. It became $174, but him and his wife were both covered for $600,000. And unfortunately, he did pass away within just having that insurance policy for 3 years. And our company paid that death claim within 19 days. Wow. She didn't make a single phone call. I did all the work for her with Samir. And this is why, if anybody's talking crap about our company, don't believe it. The people that hate us are the people that we are making corrections for. Yeah. Okay. So anyways, that's where the love relationship comes from, because if it weren't for me finding out that these people are screwing over the people that I cared about, the people that you probably care about, I would not be in this business. And because I'm in this business, I've learned so much. And you know what? That is my why. I've learned so much. I'm helping the community. I'm making a difference. And this is why I want to grow. Because the other companies are growing, but they're screwing more people. We need to grow so that we can reach out to more people. Okay. So just to piggyback on the conversation that I had, I was on a Zoom call a couple of nights ago, and the intent was for her to recruit. She said, Sheila, can you listen to my mentor? And I said, who do you work for? Well, guess what? She works for WFG. Anybody heard of WFG? Yeah. So WFG is also a brokerage, but they basically market, you know, insurance products with Transamerica, with AIG, Pacific Life, all of that. And she had been licensed for 1 year with this company. She bought 3 policies. One was a term. She bought 2 IULs, one for her daughter, one for herself. She's paying a total of $600. And even if she was licensed, they didn't put the sale under her. What who does that? I was like, are you serious? So I was like, okay. And then here's the thing. When she was recruited, she asked them, you know what? I really don't understand the policy. But you know what they say? Every single one, it has to be structured properly. It has to be structured. I'm so sick and tired of hearing that. I will tell you how to break it down, and you guys have to pay attention, because it really makes my blood boil, because these people are being screwed over and over again. Now, I didn't know at that time when I was talking to her that her boyfriend was an attorney. And apparently he was trying to be recruited. She was trying to recruit him. So I said, if nobody's going to break down your policy, I will for you. And that's what I did. And guess what? She had never logged in, okay, to our statements. Because anytime you have a cash value life insurance policy, you are, and you should, okay, you are supposed to log in and look at your statements. Okay, so anybody here, somebody knows that they have an IUL, tell them to create an account. I had to help her create an account, not her agent, who's her friend. I did. And unfortunately, she had been paying for 8 months. She paid over $3,000, and her cash value, surrender, was 0. Yeah. Anyways, moving forward. Right. Oh, my bad. I'm not tech savvy. Okay. Index universal life insurance. There are 2 different types of life insurance, right? There's term, or 3. Group, 3-year job, term, what we sell, because this is the only thing that's right for the client, and cash value, or permanent. Okay. So under permanent, you have whole life, index universal life, and variable universal life. So the index universal life insurance policy, they're categorized as permanent. And I put, well, I actually put permanent in somewhere, but I guess I didn't do it. But it's not permanent. Okay. They can cost anywhere between 3 to 8 times more than a term policy. And unfortunately, this is what people don't know. The cost of insurance, okay, just insurance itself actually goes up every year and it doubles every 8 to 10 years. All right. The fees are excruciating. They're so, the fees itself could buy a term policy with a lot more coverage than they already have. All right. The surrender charges with this particular one is 15 years. Now, depending on the company, they could be anywhere between 10 to 25 years from what I've seen from different companies. This one specifically has 15 years. And the guaranteed interest rates, most policies I've seen is only 2.75% a year, which is 0.16% a month. My bank account makes more than that with no fees. All right. So why do people buy this? They buy it because they are being sold to people as investments. And that in itself is illegal because it's not an investment. What do investments, what are they supposed to do? They're supposed to grow. I get to see a policy where with an IUL, where their money, the money that they put in, all right, grew. Okay. They're sold, and they say tax-free retirement. It's a college savings plan. And this is why people buy it. Okay. I've even seen an agent call it a Roth IUL. A Roth IUL. I'm like, right? Now, they also capitalize on that trusting relationship that they have with their clients because they know they're ignorant. I'm telling you, the attorney was being sold a $1,000 a month policy that was going to lapse in 21 years anyways. Okay. And I had to break down the policy, and that's like, you know what, that my gut feeling told me that there's something about this that didn't make sense. I spent 3 hours on Zoom with this couple. Okay. So there's a trusting relationship because it, usually it's introduced to them by, the family, the friend, people they go to church with, people they work with, or somebody they trusted already that refer them to that person. Okay. And ignorance is bliss, unfortunately. No one ever reads their policies. I'm telling you that right now. I've seen clients where I come to their homes and I said, where's the policy? It's still in an envelope sealed. They've never opened their policy. Okay. So I'm going to actually go over a real policy. Okay. So this client, she's in her 30s, she's very young, 35 years old. All right. She pays $200 a month and her base amount is $250,000. So God forbid something happened to her, that's what the family would get, the beneficiary. Pay attention to this right here. There's a 10-day right to cancel. Every policy, no matter which company it is, they have a 10-day right to cancel, meaning they have 10 days to read their policy. They don't like what they see. Everything's returned back within 30 days, they should get a full refund. But what happens? No one reads. Not one person reads the policy. And then remember I told you that they say, this is an investment. Well, if you scroll down, it actually says there, while policy values may be affected by an external index or indexes, this policy does not directly participate in any stock or equity investment. Okay. They say, oh, it's funny because they say that, oh, we actually, put your money in stock. Right there. It's bold and it's in caps lock. But again, no one reads. Oops. My bad. All right. Now, why do they call it permanent? I'm going to tell you why. Because here, if you see here, it says $250,000 to age 121. So what do you think when you're presented that? You think there's no freaking way I'm going to live till I'm 121. It's either I'm going to get that money or somebody else will, right? But they fail to see that right above there it says payable, which means that you can pay the policy till 121, but it doesn't mean that your monthly premiums are going to be the same. Even our policies can be payable to 95, but we don't tell people, oh, you were covered till you're 121. We don't do that crap here. Okay, we do the right thing 100% of the time. All right, next slide. So as I was telling you earlier, right here, she pays $200 a month, all right, for a 35-year-old healthy. Now, why do I know that these policies are only guaranteed for a certain period of time? Because it says right there, no lapse, ending date, is October 27, 2039. So it's exactly 20 years from the date it was issued. So what does it say? What does it mean when you say no lapse? It means it will not lapse, okay? But the ending date tells you that, hey, 2039, your policy may or may not be enforced. So what happened to the H121? Right? Now, how does it work? Where are my fees at? Oh, and by the way, you know how they say, like I said, they say, oh, this is an investment. Well, guess what? If they're guaranteeing you 2.75% of interest, that's their guarantee. Okay? 2.75. It may be higher, but they'll never go below 2.75% a year. Now, you might think that's great, but I'll tell you why it ain't great. Right? Yeah, hang on. Don't worry. Is there any way I could send this and we can pull it up?
Yeah.
Sorry. I'm so sorry.
Which one?
2.75, so the 5, it says 12 months, so that it doesn't. The 2.75.
No, it's every
year. Oh, it's every year. Just.
Okay. I was on a roll, man. Yeah. There's no subject. All right, so here we go. Remember I said there were excruciating fees? I'm gonna tell you how to calculate these fees, okay? The first fee, right here, it says premium expense charge. So what is the premium? This is the amount that they pay every month, okay? And it is 6%. Okay, so if she pays $200 a month, 6% of that is $12. That one fee. They have a monthly policy fee of another $12. Okay. This is where it gets tricky because right here, okay, where it says per unit charge rate, by definition with insurance companies, when you say per unit, it's per thousand of the death benefit. She is insured for $250,000, right? And they're charging her 43 cents per unit per month. That is, if you multiply 250 by 43 cents, that's $107.50.
Wow.
So this company every month is going to charge her a maximum of $131.50 from the $200 she's paying. Imagine that. A term insurance policy for the same death benefit for 35 years would have only cost her $40. You need to, oh, what I do. Next thing, all right, so fees, like when I say it's excruciating, it's excruciating. It doesn't matter which company, you just gotta know how to read them, okay? Yes.
So what amount is actually going
To the cost of insurance?
Yeah.
I'll get to that because I'm not done.
Oh.
I promise. All right, now, here's the thing, right? basically like to punish people when they surrender the policy. Meaning if you don't like what you see and you figure out that they've been crapping on you all this time, now they're gonna punish you for surrendering the policy. Okay, surrender charges, and as you can see, it says per thousand. So again, if the death benefit is 250,000, her units are 250, right? Now they're gonna charge her 2140 times 250. So it means to say that her surrender charge for the first 10 years is $5,250. Her cash value in year 2, she was going on to her year 3, she had less than $2,000. Okay, but because her surrender charge was 5,250, her surrender value was absolutely 0. Now, what is another reason people buy these policies? Because they tell them, you can borrow your money. You can borrow your own money. But they don't tell you is that you are actually funding that money you're borrowing, and they will charge you interest. So if you have your money in the bank, do you charge yourself interest if you're borrowing your own money? Would take your money from your bank? Absolutely not. But guess what? They made you believe that you're gonna have so much money you can borrow from it, but they never discuss the fees. And here's the thing. They will charge you depending on your health rating when you got the policy. If you got a standard rating, they'll charge you 3% of interest. It goes back to the company, doesn't go back to your account. Or if you got preferred rating, they'll charge you 2.25%. Either way, I should not be charged for my own money. And then every time you withdraw, it's $25. Is there anything good about this policy so far that you have seen? No. Now, remember when I said the cost of insurance increases? Right here. Okay, so if you look at this, right? Now, remember, I didn't know how to read these policies in the beginning, but I took the time to learn it. Okay, and I actually called you, said, Samir, come to and I really need to learn it. Remember that? You spent 2 hours with me going over policies. And what I did was I started calling people. I was like, look, I'm learning how to read policies. Let me read yours. That's all it took. So remember when I said the cost of insurance goes up every year? You have a question?
I did, just really quick. So that's the surrender cash value that they would get, or that,
So,
sorry,
when we looked up, remember I told you what I do is I log in.
yeah,
I make them log into their policy so that they can see their surrender value and their accumulated value.
Okay.
The accumulated value is the amount of cash value in the policy. But if that policy hasn't been enforced for more than 15 years, they're going to charge her, right? They're going to take that money, the surrender charge, they're going to deduct it from her accumulated value. And because her accumulated value is less than the surrender value, she gets no money.
but they won't have her pay that, right?
They won't have her pay
Okay,
that.
that was my question.
So
Okay.
you don't have to pay it, but if your accumulated
take it
value is less than the surrender charge, then you just walk away with nothing and you just wasted all your money. Okay, all right. So cost of insurance. So remember I said the cost of insurance goes up every year. It actually doubles every 8 to 10 years. And this is how you calculate it. You see how it actually tells you rates per thousand. Okay. Now, if anybody looked at this, they're like, they don't even know what these numbers are, right? But these actually represents dollars and cents values. Now, it may look benign to you, but here's how you calculate it. Remember, I told you every 8 to 10 years it doubles. So I'm just gonna go over 10 years. If I do this one by one, we're gonna be here till tomorrow. Okay. So when she got the policy, she was 35 years old. So she is a female, right? And again, this depends on the policy. Some of them is just a flat rate, depending, regardless if you're male or female. If you look at this right here, 35, they are charging her. Actually, this is the wrong one. Okay, 6 cents. Let's just say 6 cents per thousand, okay? So 35, 6 cents, 35 times 6. Sorry, 250 times 6 cents. Somebody do the math on it. $15. All right. So the cost of insurance will be $15 when she's 35, right? 45. Now it becomes 9 cents. Okay. Okay, we'll just say 9 cents. How much is that? For 250?
Basically 20. Yeah.
I gave the wrong one. Okay, cause CDs will go up to 55. 55. 24 seconds. But, okay.